Welcome to 2026. My goodness, these years just roll by, don't they? On this show, our first show of 2026, we're going to be making our fearless forecast, sort of that annual tongue-in-cheek exercise that's been going on this program for quite some time. And then we're going to talk about how we did last year. Of course, if we're going to make a forecast for the coming year, we got to know how we did last year to see whether we have any idea what it is that we're actually talking about. So stay tuned for that. We're going to talk about the trends that we sort of expect to drive the markets for this year, and sort of what we got right, what we got wrong for the past year. And then, as usual, at the start of the year, people like to make New Year's resolutions. So we thought we would give you a couple of suggestions as to how to maybe achieve a little bit more success on those resolutions than what the average individual does. Did you make any resolutions this year? Are you still, we're a few days into the year. So are you still on track for them, or have you already kind of fallen off? We'll talk about how you might be able to get back on track with that here on this week's edition, the first of 2026 of Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs, also a top 25 financial planning podcast on the big wide world web. To find our channels, either search for us on your favorite platform using Dollars and Cents with Joel Garris of Nelson Financial Planning, or go to our website at Nelson Financial Planning to find how you can directly link in to our channel. Once you're there, make sure you hit that subscribe button, and then that way you don't have to do that exercise again. My name is Joel Garris, Certified Financial Planner, Certified Financial Fiduciary at Nelson Financial Planning, where we got a team of great folks who also happen to be certified financial fiduciaries as well. They stand ready to help you improve your life in the new year with a successful and cost-effective financial plan. Basically, our goal at Nelson Financial Planning is to help you make better decisions with your money. So here we are, 2026. We certainly want to take a moment and wish you a happy and healthy new year. The other thing that strikes me now that it's 2026 is the first quarter of the century is actually now in the books. And looking ahead to this year, it'll mark our 250th birthday of a country here in the U.S. So obviously going to hear a lot about that during the course of this year. And then, as usual, it's not like the change of the calendar is sort of a hard stop in terms of the headlines and sort of the trends that were occurring last year. We think some of those trends will obviously continue to be some dominant themes in the year ahead, but also be interspersed with some newer themes for the year that we think are going to be crucially important for your investment performance this year. So let's begin, shall we? Last week on the program, we recapped the headlines of 2025, certainly a lot of them. And one where, as we were talking about, consistency was certainly a chief ingredient to achieving investment results during the course of 2025. If you recall the year, and if you don't, listen to last week's podcast. The reality is that the year started off with nearly a 20% decline in the markets. So if you had focused solely on that, then you might have missed what happened in the rest of the year, which was a pretty strong recovery in the markets. And ultimately, the markets wound up generating double-digit returns for the third year in a row. Certainly an important reminder, as you said last week on the program, about being consistent and ultimately not trying to not pay too much attention to the headlines one way or the other. So thinking about last year and sort of this program from a year ago, we obviously talked about some themes and some things that we thought might happen. So we thought we would start this program sort of recapping how we did a year ago in terms of our expectations, what we got right, what we got wrong. Certainly a change of administration produced what we expected in terms of less regulation and pretty significant tax reform that happened during the course of the summer months. We did get that part right, and certainly deregulation, tax cuts, all of that wind up adding to overall economic growth. We also, a year ago, expected the Fed to start to cut interest rates, although they kind of waited a little bit longer than we thought they might. Did not get around to cutting rates last year until September, and then sort of did one in September, October, and then in December. So a total of 3 for the year. Sort of expected a little bit more than that out of the Fed. I think probably the biggest thing that we got wrong, if you will, along with, of course, many others, is how much uncertainty was created by sort of the stop and start tariff approach that we saw. That obviously contributed to that big decline, nearly 20% decline in the first few months of the year, and certainly a drag on businesses making decisions as well. I think the lasting impact, I think we said this a little bit on the program last week, I think the lasting impact on that throughout the course of the year was more on smaller companies. Let's face it, smaller companies don't have the ability or the resources or the size to be able to pivot like a larger multinational company. So I think that dichotomy or that difference in terms of who was impacted or who was able to navigate around versus who was a little bit more restricted in terms of how they could navigate was a big part of sort of the underlying theme and the underlying current sort of in consumer sentiment and economic perspective. The reality is that the large companies, which obviously dominate a lot of the market indexes, found ways around that tariff uncertainty. And as we said on the program last week, certainly the theme for 2025 in terms of AI and how transformative it was, not exactly something new. AI, artificial intelligence, is certainly something that has been around for some time in various forms. We've certainly been using it at the office for several years now, particularly with our tax preparation software that kind of takes the documents and reads the numbers and then puts them into the software. It's pretty cool when you see it happen. The reality is, though, that I think it hit mainstream last year, and it seemed to jump to the front of the pages and sort of seemed to gain critical mass, if you will. So it really became a big part of the conversation last year. One could certainly argue maybe to the detriment of the labor market, because that weakness in the labor market and the tariff uncertainty and the continued inflation certainly did cause the Federal Reserve to lower rates, maybe not exactly as much or as many times as the expectation was, but it certainly caused those rates to get lowered. And we think, just as AI was a big theme for 2025, obviously we think that's a big one that carries forward to 2026. So too will the Fed and interest rates and kind of what they will do as well. On that end, I think the general mainstream media is probably expecting too many rate cuts out of the Fed. I've seen some sort of prevailing estimates that say that the Fed's going to cut like 5 different times. I don't see it happening to that number. I would say maybe 3, a repeat of this past year, 2025, but certainly not 5. I think that's a little bit high. So at the end of the day, as we reflect on a year ago and sort of what the expectations were for 2025, I would say we got the deregulation and the tax cuts right and the positive impact on that. Sort of right on the rate cuts, maybe not as many or as quickly as we sort of as we sort of expected. But the impact of AI and how big of a transformation and how much that hit the mainstream during the course of last year, I think is what was kind of the big surprise and probably the biggest reason why we undercut what our fearless forecast was a year ago. So we're going to take a break. We come back. We're going to recap what exactly our fearless forecast was from a year ago and give you our thoughts for the road ahead here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs, also a top financial planning podcast out there on the World Wide Web. So make sure you check us out. In particular, check out our website at nelsonfinancialplanning.com to learn how you can connect to us on your favorite platform. Once you're there, make sure you subscribe, and then you don't have to do that all over again. Plus, you get notified when we upload new content, which, of course, we do each and every week on all of those various platforms. My name is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of great folks who also happen to be certified financial fiduciaries as well, along with a host of various expertise. We get to have the benefit of that expertise on the next couple of radio programs. Actually, you're going to be joined by Christina Lamb, our IRS enrolled agent, and Kristen Costello on the next couple of shows as we talk about taxes and tax changes and those kinds of things as well. My name, of course, is Joel Garris, certified financial planner and certified financial fiduciary at Nelson Financial Planning. So talking a little bit about the fearless forecast that we did a year ago. Always good to kind of recap how we did last year, particularly since we're about ready to go out on the proverbial limb and make our fearless forecast for the year 2026. So as we were saying at the close of the last segment, we got the deregulation right under the new administration. We got the tax cuts right, sort of right on the rate cuts, maybe not quite as many as we might have thought, as particularly a year ago. Certainly slower than anticipated in terms of when those rate cuts actually happened. They didn't happen until the fall. I would say probably the biggest underestimate was AI sort of coming into the mainstream. Always been around in various forms over the course of the years. It's not like it's all of a sudden just came out of complete nowhere. It was always kind of lurking and building, and companies were using it. But it became, I guess, mainstream or mainstream media very much driven. And so that, I think, is a big part of what drove a lot of corporate profitability, and ultimately why our fearless forecast a year ago did not quite get as accurate as we would love it to be. And certainly our fearless forecast a year ago was perhaps more muted than the markets wound up for the year. So if you recall the show a year ago, and if you don't, you can go into the archives on any of those podcast platforms and make sure we're telling the truth, because the whole episode is out there on the internet. So you can't get away with saying, oh, I said this, when the reality is that there's something out there that said something what you actually said. Anyway, the fearless forecast is our annual tongue-in-cheek exercise. And we've been doing this for well over 30 years, or should I say, my late father-in-law, Jack Nelson, started this exercise probably more like 35 years ago. He and I used to do it together when we were co-hosting the program, and then for the past 15 years or so, I've been doing it on a solo basis. The caveat, and the reason we say, of course, it's tongue-in-cheek, in case you didn't know, the reality is that we can't predict the future. And so there you have it. So understand that this is just kind of an interesting exercise, certainly a tradition on the radio show to do it at the beginning of the year. But I wouldn't basically, kind of hold our feet to the fire on it, because we're basically trying to predict the future. Anyway, So the impact of AI on productivity gains and the tendency of that to lower costs for corporate America led to some pretty solid earnings growth. For the year, corporate earnings grew about 12% among larger companies. So, that's pretty significant, which obviously propels the markets pretty well. Our prediction sort of underestimated that. And I think that was the core thing that happened that maybe we didn't necessarily see. The reality is we still expected 2025 to be a decent year, but maybe not as strong as it turned out. If you're keeping score, our feelers forecast for the Dow was for it to close at about 45,000 for the end of the year 2025. Keeping in mind that started out the year at about 42,500, so we were certainly expecting a positive year, but perhaps one not quite as strong because at the end of the day, while we were predicting maybe a 5 or 6% type of return, the reality is the Dow wound up closing above 48,000 at the end of the year, which was actually up about 13%. The broader markets also did even stronger, with the S&P 500 up about 16%, the Nasdaq up about 20%. So I like to think that we underpromised and the markets then over-delivered for us. I guess that's going to be how we spin it, because we thought the year would be positive, but at the end of the day, it wound up being much more positive than we thought. Interestingly, it was the second year in a row where we sort of under-promised, if you will, on it. For 2024, I think our feelers forecast on the Dow was for the Dow to close out about 41,500. And it, in fact, closed out about 42,500. So we missed that one by 1,000. Last year, we actually probably a little bit more off since we missed it by 3,000 points on the Dow. And why do we focus on the Dow when the reality is the S&P 500 is probably a little bit better, broader index? Well, it's just tradition. It's what we always have done here on the program, is that we have limited our feelers forecast to just kind of that number on the Dow. Of course, back when this all started 35 years ago, the Dow was the index that everybody knew, and many people didn't know about the S&P 500, so it's funny how things change over a third of a century. So that's the recap for last year. We thought it would be 45,000, sort of under-promised it, if you will. Dow wound up closing at 48,000, so about 3,000 points higher than what we had originally thought. So that leads us to the question, what does 2026 have to offer? What are the trends that are going to dominate? And most importantly, kind of what our feelers forecast is going to be as a result of not just the trends, but also the risks that we see, right? Any year, okay, there's going to be some positives, but there's also going to be some risks as well, particularly as we start out the year. So let's get into that a little bit. We're going to start with kind of the trends that we think will be important from a positive impact in terms of the market. And as we said, the first one has got to be, we'll start with AI, artificial intelligence, and its ability, particularly as we saw this year, to drive corporate earnings, corporate profits. We think that's going to continue next year, obviously. The annual earnings growth expected for this year, 2026, is expected to be about 14% versus last year, where corporate earnings growth came in at about 12%. So still, that drive or the impact of AI on corporate profitability will continue to be a big driver in terms of earnings. And obviously, if companies are making money, then that's good for the market. We do think that those earnings will show up across a broader cross-section of companies. It's still a pretty concentrated market with what we refer to as sort of that group of 8 tech, very high AI focused businesses: Tesla, Microsoft, Google, Amazon, Facebook, you know the names. But there's a group of 8 that ultimately made up over 40% of the entire market performance during the course of last year. So yes, AI will continue to drive corporate profits, but maybe see that on a little bit broader scale. Second is that the full implications of the tax bill are going to be felt Although that may not be as dramatic as people may think, because the biggest part of that tax bill that passed last year was that it had to continue the lower tax rates from the prior several years. And so a lot of the dollars that were kind of spent in that tax bill went just for that issue. So there wasn't a whole lot of new stuff. There was some new stuff, but not a lot of new stuff. So we'll get into that a little bit more about kind of the impact that that's going to have on the year 2026 when we continue after these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning. First show of the new year, 2026. We're working through some of the trends that we think will have major impact in 2026. And then we're going to finish it up with our fearless forecast. So welcome on into Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs, also a top financial planning podcast out there on the World Wide Web. To learn more about us and what we do on a daily basis by helping people to make better decisions with their money, check out our website at nelsonfinancialplanning.com. My name is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning. So trends for 2026, we talked about the continuation of the AI trend from last year. We think that's going to continue to be a major player in driving corporate earnings. Corporate earnings, in fact, expected to grow by 14% this year, 2026, versus 12% last year, 2025. We do think that you're going to see that in a much broader range of companies rather than just the concentration that has been occurring among those predominantly AI names like NVIDIA and Microsoft and Amazon and Google. We do think that you're going to see that much more broadly in the markets. Number two that we were talking about is the tax cut. Obviously here, a lot of that tax bill went to continuing the lower tax rates. But there will certainly be an impact, particularly if you're below certain income levels, where you could certainly see some extra money in your pocket as a result of the additional standard deduction from, say, Social Security, things, the increased child tax credit, things like that. The reality is the next couple of weeks on this program, we're going to be joined by Kristen Costello who is a CPA with us here at Nelson Financial Planning, and then the following week it's Christina Lamb, who's an IRS enrolled agent here at Nelson Financial Planning. We're going to have them on the show in the next couple of weeks to really talk through kind of these tax changes, because guess what? Tax season around the corner, gearing up for that. The other impact on the tax side is that, don't forget the bill had a lot of depreciation benefits or depreciation provisions in there that are going to allow companies to expense things at a much more accelerated rate, which could lead to increased spending. Increased spending, obviously good for the economy. So theme one for 26, AI. Theme two, tax cuts. Theme three, again, a little bit of a continuation of a theme from last year, and that is the Federal Reserve and what it's going to do for cutting rates. Obviously, some of the weakness that you're seeing in the labor market, some of the higher inflation that's impacting the consumers. But there's still a pretty good amount of consumer spending happening. Corporate America is still making pretty good money. So I think it becomes a little bit of a difficult proposition for the Federal Reserve to really cut rates as regularly and aggressively as I think some folks would like. Lower rates, obviously stimulative to the economy, but you don't want to lower them too much too quick, because ultimately that generates other economic issues that can spike inflation. So we think we'll see some Fed rate cuts, but maybe not as many as what is predicted. I would say maybe you could see as few as 2 or 3 Fed rate cuts during the course of the year. I don't think 5 or 6 or some of these other predictions are accurate based on kind of what the landscape looks like. Fourth, the cloud of the tariff uncertainty that sort of overhung the markets last year. I think that continues to dissipate and perhaps remains subdued. I'm sure it will raise its head from time to time, but certainly not have quite the same dramatic impact that it did during the course of 2025. Of course, the real uncertainty on the political side of things is that, let's not forget, 2026 is a midterm election year. That's certainly going to dominate Washington and lead probably to little progress on anything that is substantive. So those are kind of the factors or the trends that we see that could be a little bit more on the positive side to 2026. If we take the flip side and talk about the risks, I think the biggest risk is just the reality of what's happened over the course of the past 3 years. You've had 3 years in a row where the markets have basically generated double-digit growth, and while we would love a fourth year, I have to sort of temper your expectations on that. The markets don't go up like this all the time on a nice, regular, smooth pattern. So I would say I would be a little concerned about the staying power of double-digit returns for the year 2026. And certainly last year wasn't exactly a smooth year with a nearly 20% decline to start the year, but it led to a very quick recovery. Again, as we said earlier, highlighting the notion of the importance of consistency in 2025. Certainly, by some measures, you could argue that stocks are expensive, and particularly when we think about kind of price relative to earnings, things like that, and that expense concern is also correlated to the concentration issue, whereby overall market concentration is really focused on a very small group of companies that basically are all in the same kind of industry. That concentration among those group of 8 companies is much higher than even in the late 90s. That those 8 companies today drive over 40% of the performance of the S&P 500. So think of it this way, S&P 500 is supposed to be an average of 500 companies, right? But because it's market weighted, the bigger, larger companies will dominate. You've got 8 names basically dominating and generating 40% of the performance in that index. That's pretty narrow. And so here's the thing I think to watch out for in 2026. Because of the narrowness of that, you could certainly see a bit of a sell-off that shows itself well or much more strongly in the market indexes. And so here's where we want to make the distinction between the markets as a whole, measured by benchmarks like the S&P 500, things like that, and a diversified portfolio. Look, as we were saying last year, the key to getting good investment results for the year was to be consistent. We believe that the key to getting in good investment results for the year 2026 is going to be diversification, because if you see any kind of weakness in this group of 8 that's all in AI, that's all in technology, you're going to see major declines in the indexes, or much more significant decline in the indexes than what very well may be happening in the broader market among a broader cross-section of companies. So you could really see where having a diversified portfolio significantly outperforms the overall market indexes. Again, that's the theme for 2026, diversification. Last year was consistency. If you were inconsistent and jumped out in response to a 20% decline in the market that started to start the year, you missed out on the full recovery and then some, and what ultimately created a double-digit return for the markets in the year 2025. We think 2026, it's not going to be the market indexes that lead the way, but rather a much more diversified portfolio that really helps to balance things out as best as possible. So we think that's going to be the big theme. The risks of sticky inflation, labor market, all of that, and midterms, and mounting government debt, all of that is a big part of that. Interestingly, if you're elected as a senator here in the midterms, then your term is going to include the year 2032, which is the year that Social Security is projected to be running a shortfall. So I would expect to see some movement more on these bigger picture issues that have to deal with government debt. And in dealing with that, you may find that that creates a little bit of a drag on the economy because the money's got to come from somewhere, folks, right? So with that backdrop, if you will, if we think about the positive trends that we expect in the coming year, we balance them out against the negative trends that we think we'll see in 2026. It could be, in a way, a little bit of a pause year for the markets, we think. 3 years in a row of double-digit growth, it becomes hard to do that on a fourth year. And along with the concept that I think diversification is going to be key and crucial to helping investors through generate overall returns for the year. Certainly be a very different story if you're focusing solely on the market. So with that backdrop, we're going to take a break and finish up with our fearless forecast along with some tips to successfully satisfy your New Year's resolutions. Coming up here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So here we go, fearless forecast time for the year 2026. The reality is that in the prior segment, we were talking about some of the trends that we see that will be positive, things like tax reform, things like additional deregulation, things like AI, all of that. And then, of course, the headwinds that you would typically expect to encounter, biggest of which is that there has been a period of time where the markets have generated double-digit returns 3 years in a row now. So the longer that happens, the more you have to think about, at some point, the market's going to pause. And in particular, I think that pause will be most seen in the market indexes because the market indexes are super, super concentrated in a very small handful of names that are all operating in the same economic space, technology, AI, things like that. So with that being said, we think the key to next year in terms of, or 2026, this year, is going to be a diversification. So the thought is that you would see your portfolio, assuming it's a well-diversified one, actually perform quite a bit better than the overall markets, given that how concentrated the overall markets are. So here we go. With those thoughts, we do think that it's going to be a bit more muted year. The market started out at 48,000 for the year. There has been one trading day already here in 2026, and that was on Friday. We're going to project, so I guess with a drum roll, please, we're going to project that the Dow closes out the year 2026 at 51,000. So a bit more muted, but the thoughts of why that will happen, and in particular the impact on the market indexes causes us to think that the Dow is going to close out around 51,000. So not a whole lot higher than where it starts the year out. But again, I think 2026 is going to be a crucially important year to make sure you have a diversified portfolio, because we would expect you're going to see better returns in that diversified portfolio than you are in the overall markets, because that concentration, we suspect, is going to sort of get less concentrated, and the impact is going to be much greater on that small handful of companies. I guess if you take our miss for this year, where we underestimated where the Dow would end at by about 3,000 points. We thought it would be 45,000 a year ago, and instead it ended at 48,000. Unscientifically, I'm basically taking that miss and adding it to the current level of 48, and that ultimately is shaping our Fielder's forecast of 51,000 on the Dow to end the year. So mark it down, lock it in. As we said, it's not an overly scientific process if I'm taking my miss from last year and just adding it on, or my underestimate of last year and just adding it on to the current level. But certainly a stab on it. At least you have our thoughts as to what the trends and the risks that are going to be vitally important during the course of next year. So guess what? A year from now, you'll get to see how close or how far off we are. That's what this whole exercise is all about. The Fearless Forecast, our annual tongue-in-cheek exercise that we've been doing on this program for over 35 years now. So lock it in. There you go, 51,000. Hopefully the explanation of why we think it's going to wind up there all makes sense. And if it doesn't, well, then guess what? You can call the office at 407-629-6477 and give us your perspective, or send us an email courtesy of our website at nelsonfinancialplanning.com. We're going to end this last segment. Obviously, it's a new year, so people like to go ahead and try and make some New Year's resolution. As we step into the new year, those resolutions have a tendency, unfortunately, to fail pretty quickly. Something like the 80% of people who make resolutions give up by the second week of January. That's not exactly a staying power. Apparently, the second Friday in January is affectionately known as Quitter's Day, because that's the day when people generally give up on their, I guess by the time you get to the second weekend of the year, you're like, the heck with it. I'm just going to go out and have fun. And that is understandable. Oftentimes resolutions are just that. They're kind of vague. They're unrealistic. They don't really have a clear plan, versus setting a specific goal, which ultimately I think is a big part of how you manage to get through a particular resolution, or ultimately make a resolution that sticks, because something that isn't really definite is easily positioned to not exactly be successful, or not exactly be achievable. So, at the end of the day, if we think about financial resolutions, and it's certainly good to make them at the beginning of any year, or really at the beginning of any day during the course of the year, the reality is the sooner you address and improve your finances, the better off you're going to be. The reality is that money touches every part of life, whether it's security or freedom or well-being. And we think about financial discipline, it's not just about budgeting. It's sort of aligning your spending and your savings and your investing with the values and the goals that you want to achieve. So the reality is that without discipline, it's going to be very difficult to create the habits to help you support those bigger goals. So a lot of people make sort of the same mistakes every year when it comes to resolutions. They don't really necessarily define why they are doing it. They can sometimes overcomplicate the process. And then, good old social media that allows you to compare yourself to anybody and everybody on a regular basis is a good way to undermine your resolution. Look, the reality is that everybody's financial journey is unique. We talk about that all the time at the office and here on the program. And it's also why we don't ever have account minimums at Nelson Financial Planning, something that we're very proud of, that we've been able to maintain now this year as we approach our 42nd year as a financial planning firm here in Central Florida. We've never had account minimums and have no intention of ever having account minimums, because we believe it's more important to meet people where they are in their financial journey. So whether you're just starting out or whether you're at the finish line and finishing strong, we're here ultimately to help you make better decisions with your money. And the reality is that if you're focusing on social media, making those comparisons, it's just easy to get off track. And develop that kind of all or nothing mindset. Look, if your goal is to get healthier and you miss one gym session, that doesn't mean that, it's not an achievable goal. If you're trying to spend less and you go kind of on a little bit of an overspending binge for a day or two, again, it's not about perfection. It's more about making progress. There's a great acronym when it comes to goals. It's SMART. You may have heard it. SMART stands for specific, measurable, achievable, relevant, time-based. That's the acronym that you want to think about as you set goals for the new year. So start with that why. What is the goal that you're trying to accomplish? Set it up so that you automate that savings and investing so that it automatically goes into that corporate, that employer retirement plan, or it automatically goes into a savings account or an investment account. The more you automate stuff, the more you take the guesswork out of it and make it much more attainable in terms of a goal that you're trying to achieve. Obviously, you want to set realistic goals. If you're trying to save $100,000 and you only make $50,000, then you've got to kind of work a little bit more with the numbers in terms of setting those specific measurable goals and sort of break it down into steps, right? If the goal is to save $12,000 in emergency savings, well, that's $1,000 a month. Focus on that rather than the big number. The goal here when it comes to New Year's resolutions, and particularly those that are financial in nature, you want to try and develop good habits. This is not a pass-fail test. It's not if you mess up once, that's it. The reality is that it's about developing good financial habits. So we hope that those are some things that you can take away here in the new year to help you improve your overall financial health. With that, we're going to get on out of here and wrap it up for our first show of 2026. My name is Joel Garris of Nelson Financial Planning. To learn more about how we can help you, visit our website at nelsonfinancialplanning.com. Hope you have a great 2026. Happy New Year.